Monday. Let me share my screen with you. As I mentioned, my notes are mine. So if you like to, these are outlines of what I talk about. If you want to, you can write these down, but it is essential for the purpose of testing that you read the chapter. That's very, very important. We talked about essentially 4 areas of finance. Corporate finance, securities and portfolio management, financial markets institution, international finance, and finance and technology. We call it fintech. I said the focus of this course is corporate finance. What you are interested in is to learn how to manage the financial health operation of a company. When we talk about corporate finance, which is the same as financial management decision making, here on top of your page, essentially, let me scroll it up just a bit. On top of the page, there are 3 areas of corporate finance: long-term investment, long-term financing, and short-term financial activities. So essentially, you can see that in the area of finance, we break things down into long-term and short-term. And whenever we talk about short-term, we are talking about 1 year or less. Most investments that we make that are longer than 1 year, such as, for example, getting into a new area of business, developing a new product, buying a building, buying a property, buying a piece of equipment, buying another company. All these activities are long-term investment activities. And the process of dealing with long-term investment activity is called capital budgeting. So within the focus of corporate finance, you can get involved in capital budgeting. What does that mean? It means long-term investment decisions. Corporation has its own money. What does that mean? It could be corporate savings. Let's talk like an accountant. We are talking about retained earnings. Okay. In terms of retained earnings, that's the corporate savings, and we will take that, and that's corporate money, and they make the investment. Another form of corporate money is issuing stock. When a corporation issues stocks and they sell it to public, they take the money, and that money is theirs. They don't have to pay it back, and they can do whatever they want with it. If the corporation does stupid things, the value of the stock will go down. If the corporation does well, the value of the stock will go up. But the money belongs to corporation. If you bought 1 share of Tesla, your money went to Elon Musk. That's his. You cannot ask that money back. Now, you want it back, you can get to sell it. Sell this stock to somebody else. Elon Musk is not required to pay you back for the investment. All right? So that being the case, what you need to do is to understand that they're using money, proceeds from selling stocks or proceeds internally from retained earnings. These are corporate money that they can use. Alternative to that is borrowing. They can borrow money by borrowing from bank or by issuing what? Bonds. So that decision is called long-term financing, or make a note, it is also a capital structure decision making. So capital budgeting has to do with long-term investments. Capital structure decisions have to do with long-term financing. Where would you go? If you recall, on Monday, I told you from personal experience, if you have little debt that can count against you, you can be penalized. I told you about buying a car. And if you have too much debt, that can also, I did not have too much debt, but I had the potential for too much debt. So that counted against me, and I was going to have to pay a higher rate on my mortgage. Again, if you recall, I mentioned that on Monday. So you have to strike a balance. The optimal level of debt and equity is also dictated by the economic structure of the country or the corporate culture. For example, railroad companies, auto manufacturers tend to have higher debt than equity. Banks have higher debt than equity. Internet company, computer company, software company, pharmaceutical tend to have lower debt than equity. They tend to have more equity than debt. So also, you take a company, US company, and compare that to identical company in Japan, the Japanese company tend to have more debt than the US company. In fact, I would say American company, US corporations, in terms of capital structure, tend to be more conservative. That is to have less debt and more equity in general. That's what we see. Essentially, debt is not looked upon very positively in this country, either personal debt or corporate debt. But again, I go back to my point, it may sound confusing. Ideally, you may think that having zero debt is perfect. The answer is no. You have to have just a bit of debt. Now, I'm not saying this so that you can run out and max out on your credit cards. That's not what I'm suggesting. I'm suggesting is to keep a healthy balance between your debt and equity. As a student, you need very little debt. But as your income rises, then your debt capacity increases. So keep that in mind. Then it comes to, these are long-term activities. In short-term activities involve short-term assets. For example, how much cash you should have, how much you need to have in terms of securities in your checking account, in your savings account, how much receivables, how much inventory. That's very important. You can have too much inventory, believe it or not. The inventory is sitting in the warehouse on your hand and it's not making any money for you. Plus, you have to pay for security, you have to pay for insurance, and you have to pay all sorts of charges to have that inventory. So it happened, like for example, if you want to buy Dell computer, technically what Dell does is takes your order and then manufactures the computers and ship it to you. All right. There are a lot of businesses that have tried to minimize inventory by basically taking the order first and then manufacturing and selling it. And you can see in this case, there may be some difficulty in terms of catching up with the demand, especially with younger generation. You guys are less patient. If you cannot get what you want immediately, then you will go to another source to obtain it, or you'd go with alternative product. So you have to have enough inventory to generate sales, but not to have too much inventory sitting there and doing nothing. So figure that one out. You need to manage that, and we try to get better and better at that. The same with accounts receivable. You don't want to extend credit to everybody, because then people will go will stop making payments. I'll give you a great example. I have the example in mind. I forgot the name of the company. Sears. All right. Your parents, my generation, your parents will be the generation after mine. I'm old enough to be your grandfather. So here you're looking at, we are familiar with Sears. It played a very important role in our life. Sears basically went on bankrupt. And one reason for it was Sears, instead of competing in terms of prices, lowering prices, what Walmart did, Sears gave credit card to every customer. You went to Sears, you got credit card. When I was student here, I was not even resident. I did not have a social security. I had 2 credit cards: Shell gas station card, which is good for Shell only, and Sears card. I was student, 0 income, foreign students. All right, and they still gave me a credit card. They didn't care. Of course, I could only use it at Sears. What happened is that people kept borrowing on that card, purchasing different items, building up balances, and eventually they came and said, oh, they cannot pay their credit card bill. So guess what they did? They defaulted. They said, we cannot pay it, forget it. They walked away. On average, in 1997, they did a study, and I know that because I assigned the case to graduate students to look at it. It took Sears more than 3 months to collect on every dollar sales. So if they sold $1 today, January 26th, it took them more than 3 months to collect it. This is not good. This doesn't work. And then, as people build up more debt, they stop paying. So what is the point here is basically you want to be careful with your receivable. How much credit you give to your customers, because it can come back and bite you and hurt you very badly. That's short-term assets. You have to be able to manage those. You don't have, believe it or not, you don't have to have excessive cash if you are holding. It is very interesting. In the US, you don't need cash. I don't know how many of you leave your house with more than $40 in your pocket. I know students who came to campus with $5. I would ask in class, how much money you have on you? Okay, I know some of them were afraid to give a large number because probably they were afraid that I would rob them. But in general, I could look at them, look at their faces, all right? And the guy would say $5. And you know how much? $5 will not even buy you 2 gallons of gas. What the hell are you doing out of the house with $5? Why? Well, you have a debit card, you have a bunch of credit cards, and that's what you're relying on. Okay, now go to a developing country. I'll give you an example where I came from, Iran. You walk around with cash. When I left Iran in 1976, there were no credit cards. There were no payment with check. You pay cash. In fact, you went to electric company and you paid your monthly bill in cash. You went to gas company, you paid your monthly bill in cash. People carried cash. Okay. The business people had their cash bundled up like this with rubber bands in their front pocket. If you wanted to borrow money, you could borrow equivalent to $1,000 or $2,000 right on the spot from somebody else. It was cash business. Which one of these is smarter? Well, if you carry your cash in your pocket with you, you are not earning interest on that. You lose money. But then, if you have too little cash, you lose up on opportunities that come along that you can make investments. So you have to manage your short-term assets, cash, securities, which are your savings account, checking account, treasury securities, and so forth, investments, receivables and inventory. On the other hand, look at your short-term liabilities. All right. What are your short-term liabilities? Accounts payable, the money you owe to your suppliers. Okay. Accrued wages and taxes. If a company, if you work for a business that pays you every 2 weeks, they have a 2-week accrued wage. On a monthly basis, as they do the statement, they owe wages to the employees. So those are accrued wages. They owe that money. Accrued taxes. What are those? For example, in my case, every paycheck, they deduct federal taxes, they withhold federal taxes and state taxes from me. They become accrued wages and taxes. I am paying those, but they are not due until April 15. The tax calculations are done, the forms are submitted. On April 15, either I have paid throughout the years a lot more, then I get a refund, or I have paid too little and I get have to pay them. I had a friend, we almost graduated the same. He was PhD in economics, and he got very excited to discover that he can increase his dependence on his W-4 forms, and he increased those. He was a single guy like me. He increased those to 9. So what happened when it came to withholding, they withheld very little taxes. So his income every month was much higher than mine, where I put 1 for myself. He got caught, and I told him, watch out, on April 15, you will have a surprise. He couldn't understand what I was saying. But when it came April 15, he calculated taxes, and then he saw how much he owes. He started panicking, and he had to run to friends and family to borrow the money in order to pay his taxes. So that discrepancy is very, very important. It is wise that you claim a lot of exemptions if you take that money and invest it. But if you claim a lot of exemptions and you take the money and spend it, well, you know what? IRS will want this money one way or the other. So you have to come and deal with them. Those are called accrued taxes. You have notes payable, the bills, the balances on your credit card that you have to pay periodically. Those become your account, your notes payable. These short-term liabilities and assets have to be managed, and that is called short-term financing activity, or we have a nice name for it called working capital management. So you have to know what is capital budgeting, long-term investment, what is capital structure decision-making, that is long-term financing, and you have to know what is working capital management, managing your current assets and current liabilities. Essentially, day-to-day business involves working capital management. That's it. We talked about the goal of financial manager. That becomes very important. As any manager, not financial manager, not just for you FRL majors, but all other business majors sitting there. Your goal is very simple. Maximize stockholders' wealth. Who is stockholder? Is the owner. So I can say owner or stockholder's wealth. We talked about that on Monday. How would you measure that? By maximizing value of the firm. So if you are asked a question, multiple choice question, given 5 choices, is avoiding bankruptcy your goal? Answer is no. It's nice not to go bankrupt, but you have not really accomplished much. All right. So no, that is not your goal. Maximizing profits. No, it is not your goal. I tell students, I give an example to students. All right. I say, if you are working for someone, whoever it is, if you are working for someone, go tell your boss that Sarmas, your professor, can triple your profits. And if they hire me, I will go there. I will fire half of the staff. Half of the staff is gone. Guess what? His costs will go down by 50% and his profits will double. But this is now. Next month, he has to go and sell. He doesn't have enough staff to do the sales. And his profits will dwindle. His business will go down because he does not have enough staff to meet the demand. So you can increase the profit by cutting costs, but that's not always an efficient way to go about profits. Maximizing profits can be a goal, but is not the main goal of a manager. Also, reducing cost, also maximizing growth, maximizing stock price. These are not the ultimate goal of a manager. You want to increase the value of the firm, and that will increase the owner's wealth. That's your sole goal. Okay. When was it? Last Thursday, I looked at the market at around 9 o'clock Pacific time. I had some put options. I was betting that the market will go down. And the market went up by 400 points. I panicked and I sold my position and I took a loss. I took about $3,000 loss. That's at 9 a.m. Okay. By about 1 p.m. Pacific time, I did something I shouldn't have done. I looked at the market to see what it is. Remember, at 9 a.m., the market was up 400 points. Typically, it's a good thing, but in my case, I had the opposite position. I wanted the market to go down, then I would have made money. 9 a.m., market is up 400 points. At 1 p.m., guess what? The market was down 350 points. I got my ass kicked. Okay, nobody could have talked to me at that time. Within 4 hours, going from losing money, I could have made money. But because I panicked and the market is so volatile, then what I was expecting, it happened, but it happened. But it went up 400 points, it went down to 0, then it went down 350 points. Imagine that. It is how crazy it is. So when you now I'm looking at the market, it was up this morning by about 200 points. Now it's down about 130 points. Figure this baby out. So what is my point? The market goes up, your stock price can go up. The market goes down, your stock price goes down. It may not have to do anything with the way you are managing your firm. So if you set your goal at maximizing stock price, you are doing everything right, but the market is penalizing you. So that cannot be your goal. Your goal has to be the value of the firm. That determines the stockholder's wealth. The stockholder wants to sell the company, they will get the value that you have created at that point. So that's your only goal. And I will come back to that and you will see why I'm emphasizing it so much. Then I said, take everything and apply it and look at it within an international context. I have something interesting for you. You recently have heard that the Russians are building up troops at the Ukraine border. One of the things that they're talking about on the news with NATO and US is what are the steps to be taken in order to prevent Russia from becoming more aggressive. They have talked about sanctions. And one of the sanction items is that to kick Russia out of the SWIFT network. SWIFT is a banking related network where the funds are transferred from banks all over the world back and forth. So if you want money transferred, let's say, from Pakistan to London, they go through SWIFT account. All the international funds go back and forth through the SWIFT account. Your checking account, your bank has a SWIFT number. So you can transfer money from your bank to another bank in foreign country, or from another bank in foreign country into your bank into US. All right. So that facilitates transaction. So they want to, one form of sanction is to kick Russia out of that network, which means Russia will have one hell of a time doing international business. No money will go into their banks, and no money goes out of their banks into foreign banks. All right. So that's one way to deal with it. Why am I bringing this up? This is essentially having to do with financial markets and financial institutions, and within the international context that SWIFT creates basically an interesting relationship between the banks. One of the things you can see on the screen is called fintech, finance and technology, and one of the things related to that is digital currency or Bitcoin. And here you have the Bitcoin. Why would you use Bitcoin for your transactions? And the reason is that you want to avoid exchange rate. So you can pay your Chinese employees in Bitcoin. You can sell your products in Bitcoin in Malaysia. You basically can avoid any, not only any foreign exchange transactions, but what you can do essentially is that you don't have to deal with the restriction, currency restrictions that exist. All right. And the Bitcoin itself can be an investment out there. And you also have, as you see, different internet facilitated, different internet finance outlets. You have smartphones, mobile banking. You also have different softwares dealing with these issues, and that's finance and technology. All right. One issue to deal with, these are different areas of finance. While you're reading the chapter, I want you to become familiar with the financial structure, the personnel structure of the company. We have CEO, who is the chairman of the board and chief executive officer of the company. That's the chair who is running the company. Then we have COO, chief operating officer. And then we have different divisions, the operation, finance, and marketing, and they each have their own chief. We have chief financial officer. So the chief financial officer essentially reports to CEO. But under the chief financial officer, we have treasurer, who deals with overall operation of the firm, dealing with cash management, dealing with capital management, capital budgeting management issues, capital structure issues, financial planning, and so forth. And then we have a controller who puts the data together, collects the daily data, operational data, will basically put together financial reports, cost report, and other financial accounting reports, and so forth. And also, they prepare the taxes. Let me see. I want to. Okay, good. Now, we talked about financial decision making, capital budgeting, capital structure, working capital management. Let me talk about different forms of organization. I want you to read that chapter, that section, very carefully. Before I do that, I like a graph. Let me share that with you. That is in your, is a figure in your. Let me see if I expand it. I think you can see it. Am I right? Yes, you can see it. This is called, this is in your textbook. It's called cash flows between the firm and the financial market. This place is important. This is basically dealing with the firm, and this is financial markets. The firm is investing in current assets, which are short-term assets. I hope you can see my cursor. And then fixed assets, which are long-term assets. They invest money in short-term and fixed assets. They invest money in inventory. They invest money by giving credit to their customers. They invest money in money market securities, treasury securities, and so forth. Then these investments provide a cash flow. Item C is cash flow. Okay. This cash flow, part of it goes to government in the form of taxes, to government and stakeholders. Understand the distinction between stakeholders and stockholders. Stockholders are the owners of the company, are people who buy the stock. Stakeholders are those who have interest in the company. For example, employees, they are stakeholders. They have interest in the company. Suppliers, they have interest in the company. Creditors, they have interest in the company. Okay, so some money will go, or some of this cash flow will go to stakeholders and government in the form of taxes. Some of it will go in the form of paying interest to the financial market, to the banks, paying the principal, paying dividend to the stockholders. That money goes to the financial market. This sort of a green box here is a financial market. And then whatever is left over, it goes back to the company, becomes retained earnings. It goes back to the company, and the company can invest. Where does the company get the money? From the financial market. They can borrow it, or they can use stock issue. So the money goes, okay? The firm issues securities, stocks, and bonds. The money goes to the company. The company invests in current asset and fixed asset. It generates funds. Those funds are paid to government as taxes and stakeholders. It pays as dividend and debt payment to the financial market. And whatever is left over goes back to the company for reinvestment. It's called retained earnings. I think this is a very nice graph, and it's good to have an understanding how the cash flow basically goes through that cycle of operation. Okay. Okay, that's what I want. In terms of different forms of business organization, I want you to read those. it's important to become familiar with those. And I want you to know each one, which is not very difficult. Sorry. And also learn the advantages and disadvantages of each. You can get multiple choice questions dealing with those. Sole proprietor is when you own your own business. If you own your own business, the business has a single owner, it's called sole proprietor. All right. Sole proprietor or sole proprietorship is very easy. I used to do consulting. All right. I had my own consulting business. I consulted small firms. It's very easy to form. You basically do an application in the city, and then I didn't even issue business cards. I didn't print business cards. You print business cards. You have a name for your business. You register your name, and you operate. There are no regulations that you need to follow. Essentially, it's an unregulated field, and you do your own business, and your profits are taxed at personal income level. I took all my fees, added it to my regular teaching income, and I pay taxes. Disadvantages. Oh boy. I would not have been able to borrow a lot of money to expand my business. The amount of loan I could have gotten was limited by the assets I had. If I didn't have a house and my car is not worth as anything as a collateral, I basically would not have been able to borrow money for my business. So capital is not available to a sole proprietor. It's very limited. Okay. Capital is limited in terms of availability for a sole proprietor by the amount of personal assets that they hold. Liabilities are unlimited. If I did something wrong, my client could have sued me and could have gone after my personal assets. I could be forced to sell my house, my car, lose my savings, and so forth. So liabilities are unlimited, capital is limited, and the life of the business is limited. I die, the business dies. As simple as that. Okay. The next thing is proprietorship. Partnership. That is when the business is owned by two or more people. They become partner. Now, the advantages are the same as sole proprietorship, but less pronounced, meaning it is just a bit more expensive to form. You have to go through some legal actions to officiate the partnership. Also, you have a more expensive, it's not only slightly more complicated, it's slightly more expensive. You have to pay a lawyer maybe to do that. Other than that, you basically should have the same advantages as in terms of you pay only personal taxes on your income. And again, the regulations are not that tough in terms of operation. There is, in terms of liability, you still have unlimited liability. The partners are liable for any damages that the partnership can cause. All right. raising capital is still limited. It's not as bad as self-proprietorship, then, because each partner can borrow money based upon the personal assets. They can borrow more money altogether, the partnership, but still there are limitations. And that is the supply of capital is limited to the type of asset that the partners have. That being the case, that is one factor. And also the life is if one partner passes away, then that partnership may have to be dissolved unless we find somebody else to step in. Or if you decide, if one of the partners decides to leave the partnership, okay? Let's say Eduardo and Melissa and I are partners, all right? I have, let's say, 60% ownership. I put 60% of the money. Eduardo and Melissa, they each put 20% of the money. All right. Now, if Eduardo decides, to leave the partnership, he's tired of us, he wants to do something else, he wants to leave, all right? In that case, he has to find somebody else to buy his portion of business. He has to go to Martin and say, listen, I have 20% ownership in this business or partnership in this business. Are you interested to take over? And if he decides to hell with it, he's walking away anyway, then the partnership will be dissolved because Melissa and I cannot handle the business. We need another partner to do the business. So you can see the life is somewhat limited. Now, there is something you can see in terms of looking at the notes. It says limited or general partnership. General partnership is that Melissa, Eduardo, and I are partners. Let's say there is 60% and 20-20. There is a $1 million lawsuit against us. We have to pay the damages. I am responsible technically for $600,000, Eduardo for $200,000, and Melissa for $200,000. Melissa comes in and says, you know what? I don't have $200,000. I cannot help you out. I cannot pay. I don't have the money. Guess what? Her $200,000 share, Eduardo and I have to take care of. We have to pay $1 million in damages. If Melissa is not going to pay her share, then that becomes our responsibility. Now, what if we have limited partnership? Let's say Eduardo and Melissa are limited partners. What does that mean? If there is a lawsuit, and if Eduardo and Melissa, $1 million lawsuit, if Eduardo and Melissa decide that they don't have the money, they cannot pay, I am not responsible for their portion in this case. I will have to pay $600,000. No, I'm sorry. Let me do it this way. If Eduardo and Melissa are limited partners, their loss is limited to $200,000. Meaning, if I come and say, I don't have $600,000 to pay, Eduardo and Melissa will not get stuck with my portion of the bill. If it is general partnership, even though there are 20%, 200,000 and 200,000, if I don't pay, they have to pay my share, 600,000. My portion of liability falls on their shoulder. They have to satisfy that. But with limited partnership, their loss, their liability is limited to the amount of investment they're making. If they have 20% stake in the business, their liability is limited to the 20%, not more. So you ask your question, why do I go with general partnership where I can go with limited partnership? The answer is Melissa and Eduardo, as limited partners, cannot tell me how to run the business. The limited partners are not permitted to participate in managing the business. If it is general partnership, all partners can get involved in running the business, in managing the business. However, if it's limited partnership, the limited partners cannot participate in managing the business. That distinction is very important. You can limit your liability per partnership, but then your participation becomes limited. Take a look at this section called Bain Oxley Act. That act came about in 2002, which basically was set up to protect investors against corporate abuse. Corporations used to make loans to their officers. The officers didn't pay off the loan, and that was taken as a loss for the corporations, and that affected obviously the stockholders. And that said and done, that became a problem. The Bain Oxley Act basically puts a control on that. It does not allow for that. Also, the annual reports have to be reviewed, not only by a third partner, independent auditor, but also by the top officers of the corporations. They have to be reviewed and approved and signed. And that is basically, in that case, they became responsible for that report and for that financial report. So they basically assign greater responsibility to.
Excuse me?
Yes.
I had two questions for you.
Yeah.
First one is earlier for sole proprietorship, you said you have limited ability to borrow money, and that's due to, did you say equity?
Due to lack of assets.
Lack of assets.
You only can borrow money or get capital based upon personal assets. Well, as a person, what are your assets? Your house, your car, and maybe some stocks and bonds that you have. So based upon assets, the bank is willing to make a loan, and not more. So the amount of capital available to you becomes very limited.
Okay, and then, yeah, thank you. And the second question was, you said limited partners cannot manage, or was that for corporations?
No, limited partners.
Limited partners, okay.
Yes. If you are a limited partner, technically you cannot get involved in managing the business. Only general partners can. So if you and I form a partnership in a business and you are a limited partner, even if you put, let's say 60-70% of the funds, for some reason you decide you want to become a limited partner. If you're a limited partner, then you cannot tell me how to run the business. You cannot participate in that. In order for both of us to have to run the business and to have a say, is that we have to be general partners.
Okay, so it forces all the partners in a limited partnership to make like cohesive management decisions, or just hire people to do management?
We are talking about making managerial decisions. So if you are a limited partner, you cannot get involved with that. So if you are interested to be involved in the operation of the business and making decisions in the business, you have to be a general partner.
Okay. All right. Thank you.
What something important is the agency conflict. You need to be familiar with that term, agency conflict, an agency problem. There are two types of conflict that we have. One is between owners and managers, and the other one is between owners and creditors. And this is what it is. This goes back to the goal of the financial manager. So let's see. Let's do it this way. If Leslie is the owner of the company and I am the manager, I have one goal, and that is to maximize the wealth of the owner of the company, maximize Leslie's wealth. Okay. If I behave in any way in order to serve myself, if I behave such that I will get promotion, if I behave such that I will get a bonus, if I behave such that I will have more free time, okay? If I decide not to go to work, instead I take a vacation or I take 6 days. If I behave in any way that is not maximizing value of the company and is not maximizing Leslie's wealth, we have an agency conflict. We have a problem. All right. So that is basically, let's say I hire my cousin in order to do the plumbing in the business, and I pay a very high price for hiring him. I hire managers who are related to me in order to serving those friends of mine, instead of hiring a more qualified managers. So I am not maximizing value of the firm. I'm not maximizing Leslie's wealth. That is a conflict that exists between owners and managers. Another conflict that exists is between owners and creditors. Let's say Leslie bought stock in the company, is the stockholder of the company. She's the sole stockholder. And Ethan is the creditor in the company. Ethan gave a loan to the company. So Ethan gave a loan, Leslie bought the stock. Now, there is a conflict. What is the conflict? Ethan doesn't care how much the company makes. All Ethan wants is the principal that he lent plus interest. That's all he wants. If the company makes enough money to pay back the debt plus the interest, Ethan is happy. Ethan will be happy with the manager who plays it safe and only invests in safe projects where they make just enough money to pay the debt and the interest. Ethan is happy. But that is not serving Leslie, who is the stockholder. Leslie would like a more aggressive manager who invests in more risky projects that will make a lot of money, which will maximize the value of the firm. So you can see that Leslie can afford to be more aggressive, so the more money she makes, the wealthier she becomes, or he becomes, sorry. Ethan happens to be more conservative, wants the principal and interest. Is there a conflict? Yes. I am the manager. Who am I supposed to serve? Guess.
Shareholders.
Shareholders. Leslie. I have to serve Leslie. I have to maximize Leslie wealth. Ethan is not on my radar. I don't care about what happens to Ethan. As long as I pay back the debt and interest, the rest is none of my business. Leslie is the one that I have to serve. So you can see there is a conflict here. So to deal with that, there are a couple of things Ethan can do. Ethan can impose restrictions, covenants in the loan. For example, Ethan can say, I will loan you the money as long as you have not paid back the debt. You cannot pay bonuses. As long as you have not paid back the debt, you cannot pay dividends. As long as you have not paid back the debt, you cannot offer stock options. So Ethan can put covenants in the loan to protect the loan, the creditor in that conflict. In a conflict between owners and managers, myself as manager and Leslie as owner, there can be a number of steps taken. For example, basically the company can offer employee stock option. So the managers over time will receive stock options to buy stock in the company. So the better the company does, the higher the value of the stock, and therefore the wealthier the manager. So managers now have a stake in the maximizing value of the firm. So that's one thing we can take a look at. That becomes essential. There could be bonuses tied to the performance. The better we perform, the higher the bonus. Now, there could be, for instance, if I, as the manager, if I don't behave properly, I don't maximize the value of the firm, what will happen is that the firm will be undervalued. And if the firm is undervalued, then guess what? Somebody like Charles Peng will come and buy the company. Charles will say, this company is undervalued. The value has to be higher than what it is because the manager is not doing a good job. They can buy the company. Even if Leslie doesn't want to sell, if it's a public company, there can be a hostile takeover and Charles can get the company. Guess what Charles will do? The first thing that Charles will do once he buys the company, he will fire me. He will look at me and he will fire me. He will say, you are the reason this company is undervalued. Get out of here. So the threat of a takeover can also convince me to serve Leslie and maximize her wealth. So there are steps that can be taken: stock options, bonuses, commissions, as well as the threat of takeover. These can minimize the agency conflict between owners and managers. The last section, as you can see on your screen, are financial markets. I want you to read these, become familiar. I will ask some simple questions. For example, primary market versus secondary market. That's very easy. Primary market is where you basically trade stocks or securities for the first time. Securities that are issued and traded for the first time. When Tesla was sold for the first time, it was in primary market. It's called IPO, initial public offering. Every week we have IPOs coming into the market. The first time they are traded are in the primary market. Any subsequent trading in the stock, any trading, the second, third, and on, will take place in the secondary market. All right. So the distinction can be primary market versus secondary market. We have dealers market versus auctions market. The dealer market is basically where the securities are bought and sold, sold for both clients and the dealer himself or herself. The dealers operate in dealer in OTC market. If you look at the last bullet, OTC, over the counter, that's where dealers operate. What that means is that if I am a dealer, if Giovanni wants to buy a stock, I can take his order. I can find a seller, let's say Ryan, and then I buy the stock from Ryan and give it to Giovanni, or I can buy the stock for my own account. I can buy Google for my own account, and then if Giovanni wants to buy Google, I can take the Google from my account and give it to him, or I can buy the Google from Ryan and give it to Giovanni. So I can trade both for my own account and my clients. And I make money two ways: a commission as I serve as a dealer between Ryan and Giovanni, and also if I sell from my own account, I can make a profit there for myself as well. Auction market is more like organized market. This is very easy. Anything that is auction market or organized, think of it with a building. If it has a building, an address, like New York Stock Exchange, like American Stock Exchange, like Chicago Board of Trade, these are auction market. And that's where we have brokers. And we have memberships. You read the chapter, you will see that both the company whose stock is traded, as well as investment banks that are trading, they have membership in organized markets. OTC, we also know that as NASDAQ, is a network of dealers, computer network of dealers, where the old orders are placed on in the computer to facilitate trade. Please read those briefly. There could be multiple choice questions on the test. It's very clear. It's very easy. We will start with chapter 5 on Monday. Thank you for joining me. I'm sorry I was late earlier. There was some confusion with setting up the Zoom meeting, but it will not happen. And have a nice weekend. Take care.